Welcome and thank you for joining this Foreign Policy Institute coffee hour. I'm Carla Freeman, Director of the Foreign Policy Institute at SAIS. The Foreign Policy Institute was founded by Paul Nitze here at SAIS in 1980 to bridge the worlds of academia and policy with the mission of finding realistic solutions to the international challenges of our time. We're very fortunate in having two experts with us today who have deep and distinguished experience in both the academic and policy worlds to discuss the differing fiscal and economic policy responses of countries around the world to the global pandemic and the responses of the leading international financial institutions to the crisis. It's my great pleasure to introduce our moderator and our speaker. First, our moderator, Dr. Gregory Chin is Associate Professor of Political Science at York University in Canada, specializing in political economy. He's a Senior Fellow of the Foreign Policy Institute here at SAIS, and he and I work together leading the project on emerging global governance, which is a joint initiative between the Foreign Policy Institute and Global Policy Journal. Professor Chin's research interests are in international and comparative political economy with a focus on China, Asia, the BRICS, international money, finance, and global governance. And Professor Chin is on the International Advisory Board of the Journal Review of International Political Economy, on the editorial board of the journal Global Governance. And his most recent project is the AIB in Global Perspective, and that includes editing a special section comprising a dozen original articles on the AIB for global policy, and that came out in December, and as I think a very important contribution. So thank you, Greg. And now let me introduce Professor and Dr. John Lipsky, who's a Senior Fellow of the Foreign Policy Institute here and also a distinguished scholar at the Kissinger Center here at SAIS. And before he joined SAIS, Dr. Lipsky served as first Deputy Managing Director of the International Monetary Fund from 2006 to 2011 during another significant crisis. Previously, Dr. Lipsky served as Vice Chairman of JP Morgan Investment Bank, Chief Economist of JP Morgan Chase, Chief Economist and Director of Research at Chase Manhattan Bank, and Chief Economist of Salomon Brothers. He's currently co-chair of the Aspen Institute's program on the world economy, and he also serves on the executive committee of the National Bureau of Economic Research, on the advisory board of the Stanford Institute for Economic Policy Research, and as a director of the Center for Global Development. So you can see we're very fortunate in having both John and Greg here with us today. I'm about to turn the meeting over to Greg's excellent leadership, but let me first go through some technical announcements. I just want to remind the audience that this conversation is on the record and it's going to be recorded, and then we will post it on the Foreign Policy Institute's YouTube page. There will be an opportunity for you, the audience, to ask our distinguished experts questions, and we'll have a Q&A at the end of the conversation. And to facilitate that, be very grateful if you would use the Q&A feature which is in the toolbar at the bottom of your screen to submit your questions. That then Greg will take a look at and we'll try to answer as many, address as many of those as possible. But we'd really appreciate it if you would not use the chat function, but rather stick to the Q&A function. And when you submit your questions, please state your full name and affiliation for us. So without further ado, let me turn the program over to you, Greg. Thanks.
Thank you, Carla, for that wonderful and generous introduction. Thank you very much. And I'd like to just hand right over to John Lipsky, to John, and have John present. I think, we'd all like to hear that. Thank you.
Okay. Thanks, Greg, and thanks for moderating. Carla, thanks very much for the invitation and this opportunity to address the Foreign Policy Institute and our friends, colleagues, and anybody watching. We're going to be talking about financial and economic aspects of this crisis. But I think before we begin, we shouldn't ever forget the human costs that this has entailed. The lives lost, lives disrupted, and the huge uncertainties that have been created and stay with us. I also think that one of the aspects that has been underscored by these events is our elemental interdependence. That may seem ironic because many thought that the initial response was one of nationalism and isolation. But I think, first of all, we have to remember that the burdens being borne of the costs of the human costs and other costs of this episode are being borne quite unequally. But I also think that the reality has set in here I'm speaking from Brooklyn, New York. At 7 o'clock, all my neighbors step out onto their stoop and applaud the first responders and medical workers and others who are bearing burdens that many of us don't have to. But there's also been, as we see today, an explosion of virtual communication that has drawn us together. And I think we increasingly recognize, everyone recognizes, that we need to make things work coming out of this episode, and it's going to inevitably require cooperation that reflects our interdependence. Of course, huge uncertainties remain, as I've already mentioned. Some of them are, let's call them medical, biological, some of the things that we can't control yet, and we're not sure how the course is going to run. And this is reflected in economic uncertainty and financial uncertainty. Already it's commonplace to note that we're undergoing experiences for which there is no modern equivalent. And so we're all moving into the unknown with the uncertainties that entails. Now, today we're covering what could be the broadest of topics, but I'm going to make a presentation to start. Then I'm going to utilize a comparison with what happened in the global financial crisis. I do it very briefly because I think that it will allow me to emphasize in high relief a few points that I think will be of interest to the SAIS audience. But then Greg and I will have a discussion, and then we can turn to your questions. And I just want to say, happy to discuss. My own presentation in the next few minutes is going to be rather narrowly focused, but I'm be happy to address broader questions that you might wish to explore. So if we can put up the presentation material. Great, let me go to the next. There we go. Okay, I'm using this page to just make clear the points that I want to address in my presentation. First, I want to talk about this time around in comparison to the global financial crisis. The policy responses, I've said here, been much faster, it's come much faster, have been much bigger, and ironically, with less coordination than was the case in the global financial crisis. I want to make sure that we understand there are different challenges and different strategies, and I mean this two ways. One, that this crisis, COVID crisis, differs in many important respects from the challenges represented by the global financial crisis, and therefore the tactics being used by policymakers actually differ quite significantly. I also want to emphasize that there's a great difference in the responses of individual countries, as we'll see. Then I want to turn to the monetary aspects and want to make sure that we understand that the global financial crisis entailed a change in the structure of the way central banks were ordered in the world. And if anything, that has been underscored and emphasized by the latest developments. I'll explain that when we get there. But I think we can easily summarize this point in saying, in case you had any doubt, who's the boss? It's the Fed who's in charge of the world's central banks, and they're acting like it. We'll come back to that. Also, this time around, compared to the global financial crisis, it just appears that there's been assigned a smaller role for the international institutions, despite the quite aggressive and responsive actions that they have been taking. We'll come to that and take a look at what I mean specifically. And then finally, the G20, which had been sort of left in the dust after having been created in response to the global financial crisis. In fact, I would say that the creation of the G20 Leaders Summit process was the principal institutional response to the global financial crisis. It seemed to have disappeared, and in fact, there was a emergency G20 Leaders Summit back in March that produced nothing. But in case you didn't notice, last month, or 3 weeks ago now, sorry, there was a ministerial meeting that seemed to restore, in many ways, the role that the G20 had taken for itself. And we'll talk about that in some detail. Okay, let me run through these points. I have some slides that hopefully will make the points clear visually. Next slide, please. Okay, global financial crisis. Back at the IMF, where I was serving at the time, we concluded that the financial crisis had gone global in August of 2007, when some important institutions, financial institutions that managed money, closed their funds to redemptions, a sign of a degree of crisis that we hadn't seen before in decades. And yet, we couldn't get anybody's attention. If you remember, in January 2008, the then managing director of the IMF spoke in Davos and said we needed to have 2% of GDP fiscal stimulus for advanced economies. In March 2008, I myself gave a speech in which I entitled Think the Unthinkable, in which I said, we stated that fiscal support for financial institutions was going to be necessary. Within weeks after that, Bear Stearns went bankrupt, and yet nothing much happened in policy terms until Lehman Brothers collapsed in September 2008. When that happened, then things got into motion. The G20 was formed within weeks after the Lehman collapse, and the first G20 Leaders Summit occurred just weeks after that. And the first G20 Summit in November 2008 came up with a very detailed agenda of things to do and institutions that were to do it. And rolling forward into the April 2009 London Summit, it agreed a lot of action. So here you can see in the total fiscal response of the G20 countries back in 2008, 2009, 2010. In total, it was quite substantial. But it was slow in coming, but it was coordinated. The G20 endorsed 2% of fiscal stimulus in the advanced economies, and the G20 produced just that in 2009. Okay, what's happened this time? There's the point. The point is that the response has been much, much more rapid within weeks or months of the COVID crisis becoming evident. There was a huge fiscal and monetary response, but with no explicit coordination among countries. Much faster, much bigger, and less coordinated, at least in terms of any explicit agenda or an attempt to communicate that we were acting together. Next slide. And here you can see the significant differences in not only in the scale of the actions taken, but the nature of them. Perhaps you can't read these. Eventually, you'll be able to download these slides if you want to see them, but the points are following. A substantial amount of the 2009 stimulus involved tax cuts, involved public investment, in other words, infrastructure investment, and some amount of unemployment insurance and some other things. This time around, basically, no one is engaging in tax cuts. And there's virtually no infrastructure project used as a counter crisis element. Instead, you have huge expenditures on job retention schemes, direct cash payments, direct support to healthcare, and only a small slice to infrastructure investment. In fact, within the EU, more broadly, it appears that in the G20, about 1/3 of all workers are now being supported by some kind of public sector job retention schemes. The EU, certainly in the Eurozone, there are as many folks who have moved on to job retention schemes of various kinds as there have been increase in unemployment in the US. And now everyone, including the US, is engaged in increasing various kinds of job retention schemes. Here in the US, it's this PPP, the Payroll Protection Plan. We'll see how big it gets and how effective. So globally, we're going from a fiscal deficit last year, globally, of about 3.2% of GDP to over 11% of GDP. In the US, many estimates suggest that we'll have a deficit this year that could accumulate to 20% of GDP or higher. Totally unprecedented. But next slide, please. Here we can see the differences between different countries. Now, perhaps, hopefully on your screen, you can see that. I guess actually you're watching it on the same screen as I am. So it's as clear to you as it's clear to me. Got to get used to that. But what must be very striking, here we have the G20 countries and the total fiscal response in percent of GDP. And I'm going to suspect that many of you hadn't realized how broad the differences have been. On this slide, if you look, the orange bars or burnt umber or whatever you want to call that color, those are budgetary measures, either revenue or expenditure. The gray bars show below the line measures, in other words, that increase loans, equity injection, or guarantees instead of straight budgetary expenditures. And you can see the fantastic differences from country to country, and which the US is really not one of the leaders in terms of total fiscal effort. Now, in case you're curious, my old colleagues at the IMF have created on their website, the imf.org website, what they call the IMF Policy Tracker. You'll find it right on the homepage. It will give you the minute details of each country's actions. You may find that quite interesting. And similarly, if you're interested in more detail on the fiscal measures taken so far, the IMF's Fiscal Monitor will provide a publication that just was out a week before last that will provide more details. So that's the fiscal side. Now let's turn to the monetary side. Next slide, please. And here you find something that I think many of you who follow this will know very well, but perhaps others not. The view here is that the Fed has become hyperactive and leading the way in terms of providing various kinds of support, especially so-called quantitative easing, QE, of taking on assets from the financial sector or elsewhere, accumulating government securities here in the US, including also various kinds of asset-backed securities, and more innovatively perhaps, their so-called Main Street programs providing support for small businesses that is absolutely unprecedented. But we can see here that in fact, up till now, of the three largest central banks, the Federal Reserve, the Bank of Japan, and the European Central Bank, Bank of Japan has been far in the lead for years in terms of the scale of their involvement in the domestic economy. But here's the point. We've taken it for, by the way, the Fed's action since this graph, I just couldn't come up with the up-to-date data and to make it comparable. The Fed now probably is up to about equal to the ECB, but the ECB itself has announced, as you know, aggressive new programs of, let's call it quantitative easing or balance sheet expansion, for want of a better term. So a couple of points are worth making here, in addition to the fact that the Fed is not leading the way in this case. One, there's a sense the sky's the limit. that the central banks basically have carte blanche to do whatever, pretty much whatever they can. A lot of folks have noted that monetary policy seems to have wandered over into the terrain that would have been considered fiscal policy. I would say yes. And the answer is it's an emergency. It's all hands on deck. This is no time for a theoretical or ideological purity. Everybody's doing whatever they can to try to provide support for economies that have been shut down, not because of economic problems, but because of government decrees to deal with the pandemic. I just want to clarify the one thing I keep hearing folks who look at the ECB and keep waiting for I keep hearing it exactly this way. Remember back in 2012 when Mario Draghi, then the president of the European Central Bank, said, "We'll do whatever it takes, and believe me, it will be enough," is what he said. People forget what he was talking about was supporting the euro at a time when there was active talk that perhaps the euro was going to start to fall apart. 2 years later, Mario Draghi spoke at Jackson Hole at the Federal Reserve's famous symposium there, and talking not about the euro, but about the Eurozone economy and how could the ECB contribute to making the Eurozone economy grow better, more balanced, and more strongly. And it's my paraphrase of what he said then. And what he said was, "We'll do whatever we can, and believe me, it won't be enough." What he was saying is they needed structural reform and fiscal support if that was going to happen. So to look today to the ECB to solve the problems and to say they're not doing enough, I think misses a point. They're doing a lot. And as you can see from this chart, which may have surprised some of you, they started with the lead over the size of their balance sheet relative to their economy. Well, there's another aspect about the central banks that I wanted to indicate. In the wake of the global financial crisis, excuse me, let's put up the next slide, please. In the wake of the global financial crisis, there was one explicit institutional change in global governance, and that was the creation of the Group of 20 Leaders Summit process. I'm going to talk a little bit about that in a few minutes, but there was something else that went on. If you remember, many people don't actually, that in the immediate wake of the collapse of Lehman, there was a freezing of the interbank market, especially for dollar assets. A lot of European banks had been purchasing dollar assets when they had no natural way to collect dollars. And they essentially went out and borrowed dollars to invest in dollar securities. And when the interbank market froze, I should say, parenthetically, about 50% of US toxic mortgage assets were on European balance sheets at the time of Lehman's collapse. Many European banks simply had no way to acquire the dollars necessary to support the dollar liabilities to support their dollar assets. Important swaths of the European banking system would have been illiquid and eventually insolvent if they couldn't get their hands on dollars. It was the Federal Reserve that created an unlimited dollar swap line with the European Central Bank that it could on-lend to its banks that saved the European banking system, a fact that often seems unknown to even many Europeans. But to avoid a similar problem, subsequently emerged a network of permanent unlimited swap lines between these 5 key money central banks. As I put it, created a kind of a first class of central banks that had these lines. In 2008, the Federal Reserve granted swap lines to 4 emerging market countries, something they had never done before. They were temporary: Brazil, South Korea, Mexico, and Singapore. And as I called it, that created a new business class of central banks or the favored friends of the Fed. I call it the Triple F Club. A few weeks ago, the Federal Reserve granted, once again, temporary swap lines to 9 additional central banks listed here. So the business class is a bit bigger. But the point is, there is no doubt that the Fed views itself as the central banker of the world, at least the central bank that runs the dollar, which happens to be the world's reserve currency. And only the Fed board knows in advance who's a member of the FFF club. And only the Fed board knows what the criteria is. It's kind of a funny way to structure the world system, but that's where it is. As I put it back, and when this evolved, that created implicitly a steerage class. Maybe that's a little too pejorative. Everybody else was supposed, if you had a problem with regard to funding, go to the IMF. I didn't think that was the most constructive way to manage the system. But now, the IMF, with the support of the G20, has created a new short-term liquidity line, or SLL. This is a kind of swap-like facility. It was just established last month, but it was limited to countries whose policies were deemed to be completely adequate without any change needed. In other words, hardly anybody is going to fall into that category. And if they do, they probably are not going to use the SLL. But now we have a premium steerage class of folks who go to the IMF. So this is now, in a way that was not clear before, quite firmly established, this tiered order of world banks, of world central banks. And as I put it, in a way, you think the Federal Reserve there's a confusion. There's another institution in Washington, headquartered in Washington, called the World Bank. But the Federal Reserve is the World Bank right now. Next chart. Next slide, please. Well, here we can see another difference between the global financial crisis and now, and that is the much more limited ambition that the G20 has assigned to the international institutions compared to in 2009. If you remember, the G20 London summit adopted these then large size and striking size measures to support the IMF and other multilateral development banks. $1 trillion in new assets or new resources for the IMF. They created a completely new facility, the flexible credit line, which was a line designed, a fund facility with no limit to its size, that was used by Mexico, by Colombia, and by Poland in the context of the crisis to good effect. The fund was allowed to use gold sales to finance subsidies for low-income countries. The G20 acting in the Pittsburgh summit in September 2009 made it clear what they thought of their role. Their role was, as they say textually, this is quoting from the September 2009 G20 Leaders Summit. Today, they said, we designated the G20 as the premier forum for international cooperation. In other words, we're now in charge. We control, we the G20, represent 65% of world population, 75% of world trade, and 85% of world GDP. And we will tell the other international institutions what they should be doing. And in fact, they even established a new one, the Financial Stability Board. What has happened this time around, first, as I've already stated, there was, and I would also say in the interim, there have been a bunch of G20 leaders summits in places like Los Cabos, St. Petersburg, Berlin, Buenos Aires. You probably haven't paid much attention. It's as if the G20 was being laid aside, or put in some kind of limbo until a crisis arose. So then the question was, so here's a crisis, what are they doing this time? The leaders held a virtual meeting earlier that produced a 3-page statement that said virtually nothing. It was quite astonishing. And then almost out of the blue, the finance ministers of the G20 meeting a couple weeks ago issued a 14-page communique with detailed instructions for all the international institutions. It's as if at the ministerial level, they're back in charge and telling folks what to do. But with regard to providing new resources, their view was with regard to the IMF, that the IMF already has enough resources to do what it needs to do. And that's assuming that what they need to do is to deal with the low-income countries who are going to be very seriously affected by this pandemic. And this raised an interesting and potentially very important and telling proposal with regards not only to the fate of the low-income countries in the near term, but for the whole international system. The G20, the IMF and the World Bank already had endorsed a debt service moratorium for low-income countries earlier in March. The ministers' meeting endorsed that. Something else notable happened. Not only did the IMF and World Bank endorse a debt service moratorium for both multilateral and bilateral official credits to low-income countries, they also endorsed a move by the Institute for International Finance, which is a voluntary grouping of, you probably already know it, of mainly private sector lenders who operate internationally. The IIF called on its own members to also enter into debt service moratoriums with the low-income countries. Here's what's particularly interesting. So there was action for the countries that hadn't yet taken action and looked like they needed significant help. Those the G20 was willing to enact or recommend unprecedented support. Next slide. Here's one reason that's interesting. If you can see, look at the multilateral, look at the blue bar in this chart. Basically, multilateral lending to these low-income countries hasn't increased since 2010. Basically, all the increases come in the area of non-Paris Club official lenders and commercial. And that means mainly Chinese official and institutions like the China Development Bank that is considered by the Chinese not to be an official institution. So the biggest chunk of increase is from China, which is now the largest lender to these countries. They are also a G20 country. They had to agree to that statement calling for, number one, not just a debt moratorium, but number two, increased transparency on debt. And third, to respect what, for want of a better phrase, pari passu terms. In other words, that in debt restructurings, everybody should adopt the same restructuring terms rather than get into some kind of competition with these weak, essentially vulnerable, let's call them vulnerable borrowers. So heretofore, as you're probably aware, China's position has been that their lending to low-income countries is a matter of bilateral policy, and it's not, basically, it's nobody else's business. And the question here is, despite all the tension internationally with China, fomented to some degree, no small degree from Washington, but not only from Washington, are the Chinese authorities now taking an important step forward that says we're now willing to act more like we're members of the club of other advanced economies. This is very important. Watch this space to see what happens. We can take the slides off now. So I'll leave it with this, but one final thought on what's happening now and on the G20, and then we'll move to talk with Greg and your questions. So what have we seen? We've seen that the advanced economies acted rapidly and in size with actions to bolster themselves. Not coordinated, but similar in context because they were reacting to similar problems with different levels of aggressiveness. They did come together, and we'll see, the proof is the pudding's in the eating. They did come together to provide support to the most vulnerable countries, the low-income countries, for whom everyone is quite concerned because there are so many ways that they are going to be, are being and will be adversely affected by this this pandemic that is absolutely not of their doing. Who's left out? This is the part that has left me frankly puzzled. There are a bunch of large emerging economies who are also under significant pressure. Turkey, South Africa, Indonesia. Those are G20 countries. They're not in the FFF club. They are in the G20, but the G20 was silent on providing any help for them. Brazil, that's a G20 country. It is in the FFF club, but the Fed is only there to provide swap lines. It's not going to provide budgetary support or anything of the kind. Argentina, that's a G20 country. It's already in deep trouble. It has a very large fund program, and it has trying to restructure its debt. It's made a very aggressive offer with its debtors that has been universally rejected by the debtors. The G20 was completely silent on their own members who potentially are going to have significant problems. There are others who are non-G20 countries, Nigeria, which just recently made a small borrowing from the fund, well, small, $3.4 billion, but it's really a liquidity facility, not a program. Pakistan, similarly, has a program, but probably has much bigger needs. Those aren't G20 countries, but they're big in emerging economies. There's a lot of questions. So if there's an area that ought to be of interest to the SICE audience, here are three. Does the G20 ministerial mean that the G20 is really back in business? Does the deal, the G20 deal on low-income countries, means that China is going to start to live by the same rules that that other advanced economies are following? There's a subtlety here, by the way, that I meant to mention before. Also, the G20 ministers pushed back the target date for a realignment of IMF quotas to 2023. This is important. Believe it or not, that was originally scheduled for October 2012. And when the IMF quotas were last realigned in 2010, China itself was adamant it did not want to be number two. Japan is number two. The clear understanding was the next time around, they're going to be number two. 2023, we'll see. Are they going to step up into the number two slot with all that implies in terms of their relative role? We will see. And third, is what is going to happen to these large emerging markets who have just been seemingly left behind in all the strategizing. Well, that concludes my remarks. Greg, over to you.
Well, thank you very much, John, for your excellent presentation. You've given us such useful information to think about and strategic analysis. It's really helpful to have a clear accounting of the differing national responses, the way you did with your charts, which were excellent. And especially to give us a sense of how different countries have been trying to act to contain this public health and this public health crisis and this growing economic crisis, and the global efforts that you've highlighted. And I think especially the way you've given us this excellent analysis of the playbook last time in 2008-09 with the global financial crisis, at what's happening this time and what we're seeing. And I know it's a moving target right now, so it's very difficult to do this analysis. But this is, from my standpoint, from my knowledge, the first accounting from the systemic level that I've heard. And so thank you very much, John, for that. That's excellent. Yeah. And the connecting of the dots and the identifying of gaps in the system. I think this is just so useful, John. So thank you. I think the other thing you've given us a sense of is what to watch for as well, what to track moving forward, including this interesting question of China's relationship to the G20 and within the system, and to the nexus of institutions and how we're trying to respond, both in containing the public health crisis, but also the broader contagion into an economic crisis, and from a national to the global scale. And so I think that, what you've given us as far as what to watch for, I think is really bang on and so important. And I think we're all kind of grappling with thinking through how can we cope in this current scenario? How can we navigate? Yeah. There's people who are giving us the doomsday scenarios and the worst case scenarios, one building on top of the other. But I think in quite a service, from your profession as a top economist, you're giving us some tools on how to think through what are our options, and what are the potential solutions, drawing on your rich experience in dealing with crisis management at the global level. So thank you very much, John.
Thank you.
Yeah, and I'd like to definitely return back to, I think we've got somewhere between maybe 10 to 15 minutes, then I'll try to open up to the Q&A to our global audience. What I'd like to do is definitely return back to your comparison of the before 2008 and what's going on now. But before I do that, if I could just ask you, I really like how you brought the crux of the analysis to this question about the G20, IMF, World Bank, Paris Club, Institute of International Finance, where they meet China. Mm-hmm. And this question of how are the Chinese responding and how might they respond? And for those who haven't watched your presentation from about a week ago, I really encourage them to do that, because you did another FPI presentation about a week ago, where I think you raised some really important points about how the pressure will be definitely put onto China from the collective grouping, the non-China members of the G20. And so how is China responding, and how should it respond implicitly as part of your discussion? And I think it was quite interesting today. Maybe if I can just share a little info, you've probably seen it already, John. It looks like in today's Financial Times, there's been some reporting on how the Chinese are, yes, they're getting all kinds of requests now as far as debt relief from a number of the countries that they've lent a lot of money to, that your charts showed so well. Kind of countries from Central Asia, Belt and Road countries, all the way to Africa. And, we know that China's done this big push on, as a creditor globally, big infrastructure, big power projects around the world since 2013. And your chart showed it so well. And there's talk now that there's something like 138 countries that have signed up to Belt and Road, and borrowing different amounts of money from China, and many of them have weak credit ratings. Right, so that this concern about the what could be looming as far as a serious kind of debt crises, and so you've mentioned then the whole debt service moratorium agreement at the G20, and supported also by the IIF, and I think that's really important because China's also a member of the IIF. It's China's banks, yes. And so so I think I think Deborah Brodigan at Johns Hopkins SAIS, the China Africa Research Institute. Her institute has come up with, she's talked about Africans borrowing, a significant amount of money from like somewhere around $143 billion. That's the African countries between 2000 and 2017, so over a 17-year period. And there's a lot of concerns now, and supposedly the Chinese are getting a lot of requests for debt relief. My understanding that what's starting to emerge is that China's saying, we are starting to think through different options. First thing is maybe canceling interest payments. They don't want to go to complete write-off of debt. They're trying to think through incremental steps, and very differing borrowers, those who are stronger. Okay, maybe we can do some, more delay, give them more than just a 1-year delay that the G20s, I think a couple of years, and then only in the kind of last case scenario, complete debt relief. And I think in some ways, I guess all countries would have to think this through, not only China, right? Whoever's lent money. So it's not just China. Like sometimes China is criticized for, they only wanted, bilateral solutions on this. But in the end, it kind of all comes back to, right? If it's bilateral monies, whether it's official or private lending, it's still going to come down to probably some type of bilateral negotiation, right? On the whole debt servicing details, right, which would take time to hammer out. So I think now China is trying to think this through and trying to kind of work it out. But I agree with you, this is a massive challenge for China.
Yes, it is.
And so if you have any thoughts on that one before we go then to the 0809, I'd love to hear your thoughts.
Well, I'm going to sneak in. Thank you for that, Greg. And I'm going to sneak in one thing I did want to say. There's also at a certain level, there's this image that there's no coordination, no cooperation going on. I suspect this is an artifact of watching only at the very tippy top. And I think if you engaged at a working level, at a deputy secretary, undersecretary of Treasury level, you will find the US is quite engaged in ways that if the issue was politics, that's one thing, but at a working level, the US seems to me that it's quite engaged in all this, along with, and not just on its own, with its allies. In other words, at the working level, there's still a lot more cooperation and communication than you might believe if you just read the press or just watch the TV. And on this area, as I suspect this audience knows very well, Paris Club has been constituted for a reason. And the idea being that allies, at the edge, there's always competition, but in the main, understand it's not in anybody's interest to deal with these vulnerable borrowers by pitting one creditor against another, trying to get a better deal than the other guy. That this needs to be done in a coherent context. Paris Club renegotiations have always required IMF programs to make sure that the country's following plausible policies. It's going to be very difficult at this time because of the fantastic uncertainties. And again, let me slip this in. This audience may be well aware, the amount of capital outflow from the emerging markets and developing economies that hit in the month of February and March is 3 times the amount of capital outflow that occurred during the global financial crisis. The IIF estimates it about $100 billion left these countries. In addition, their export prices have collapsed. In many cases, especially in sub-Saharan Africa, they're having production problems with things like locust infestation. It's a terrible time for many of these countries. Plus, many of them rely on remittances of their workers their citizens who are working abroad. So this is a particularly difficult time, and it's a difficult time to forecast. So it's I think this really explains why the initial statement, let's have a moratorium to the end of the year. I don't think there was any notion that at the end of the year, everybody can just start paying up. I think the idea is, okay, when we get that, let's see where we are as we get there. But I don't think this is a big problem and it's going to need a big solution. The Paris Club is going to want to arrive at a coherent solution. And the issue is going to be, it was one thing back in the global financial crisis or before when China was a modest or marginal lender, and now they're the big lender. And the put it this way, Paris Club is not going to be in a mood to say, we don't need to know what your terms are, your terms of restructuring are. We're happy if you use our funds, if the borrower uses our funds to pay you off. So, and to be honest, it's easy to sound a little bit fearsome like that. But my understanding is that the Chinese understand this. And the question is, how far do they want to go in terms of accepting the pre-existing rules of the game, and how much do they want to insist we want to shape the rules? This is going to be absolutely crucial. And as I was trying to imply, that perhaps the setting of the date for the quota adjustment suggests there's a payoff. Cooperation means you will become officially number two. And I think at this time, whereas in 2010, China did not want to be number two, I think at this time, I think it's in everybody's interest if the quotas reflect reality, the new reality. So it's all in a ball. It's all, to me, extremely important. And the initial signs are that for sure, China recognizes it has to move toward a more cooperative stance in this area.
Right. Very good. Thank you, John. Yeah, if I could just bring it back to your comparison of 2008 global financial crisis.
You're an expert on this topic.
No, no, you are. And the playbook last time and this time, I guess, there's a lot of talk, of course, of missing global leadership, whether there's been a lot of finger pointing going on between the great powers, yeah, whether that's been helpful or not, whether it makes sense to launch an investigation into the WHO at this point, yeah, or focus on, finding solutions. So we know that there's a number of political factors this time around that seem to be not allowing for coordination and cooperation between the key actors. Last time we talked about a kind of G2 within the G20, China and the US, and how important that was. This time, now people talk about the death of the G2. And so, and I think this is where, I think we all kind of have a sense of how that is part of the challenge this time around. And would you say also, John, that part of the challenge this time around in finding, kind of solutions and containing this crisis, perhaps is the nature of this crisis as well, in the sense that 08-09 was largely a financial crisis, also became a, export finance kind of trade crisis to some degree.
Yes.
And then eventually, spilled over into Europe as a potential currency crisis. But it kind of stayed within a certain realm of trouble, and a realm where the IMF has a lot of experience, and we have other kind of architecture that is used, has been used as I think you believe, IMF, when given like $1 trillion at the G20 London summit, had a lot of firepower to try to calm markets and do whatever it takes, quote unquote. And so, but this time what we're dealing with is something that seems to be really stretching the capacities and the gaps in the house of global governance, if you want to call it that, because it's this health pandemic going global, and then now spilling into economic crises of various sorts. As you've mentioned, monetary responses, fiscal responses, just to help people survive, I think, as you're saying. And so maybe this time, do you have any thoughts about, is it also about the fact that it's really tough to get people in the same room to deal with the crises this time, the health people, the pandemic people, and then the IMF, World Bank people, the WHO with its links to the, the core nexus that you've mentioned. Like, I wonder if this is also part of it, so just the fragility and the gaps in our system.
Well, for sure. And of course, part of it is that we've never been through this before. The economics and financial problems derive in the main from the pandemic and from the government's actions to try to stop the pandemic rather than being internal to the economy per se, as was the case in the global financial crisis. Although, as I was trying to suggest before, there was the folk wisdom is it started in Wall Street and infected the world. And as I was trying to suggest, 50% of the toxic assets were on European balance sheets. They were enablers as much as US savers of the imbalances in the system. That we don't have to relitigate that whole thing, other than when finally folks got into action, they got into action in a coordinated and collaborative way. And I was convinced that one of the ways that the sense of panic and decline was halted was the confidence building that derived from seeing the leaders of the principal countries get together quickly and agree on a coordinated course of action. And I think we've just, to a large extent, forfeited that potential benefit and added to what is already a very uncertain situation with the notion that there's conflict and not just the US and China, Saudi Arabia, Russia, is Washington and Europe, or et cetera, et cetera. So this strikes me as unfortunate, and I don't think it's been highly productive.
Right.
So nonetheless, or I should say, certainly the IMF and the World Bank have made efforts to at least to show collaboration with the World Health Organization, with others, to try to indicate that there's an attempt to be coherent in terms of dealing with the situation. Truth of the matter, and as I'm just repeating myself, it seems to me at the working level, i.e. Deputy Secretary, Deputy Treasurer, Deputy Minister level, there's still real cooperation, not just talk, but real cooperation. All that being said, we're dealing with a kind of a problem none of us have ever seen before. The governments have decreed the shutdown of the economy. We're trying to figure out, the authorities are trying to figure out, how do we provide income support to these people who have been deprived of livelihood because of policies for which they bear no blame, and in the absence of any real mechanisms that will work well. At the outset, it looks like these European methods of income support to keep people in jobs appears to have its benefits. But I'm sure it all partly depends on the scale. We're all going to have challenges and problems. But of course, it's obvious in the US, we're going to have an unemployment problem.
Right.
Of who knows how, but it could be as big as it reached at least a peak that's not so far from the peak of the Great Depression. So it seems to me, it's already obvious that different places are trying different things with different levels of apparent success. And we could all be helpful to each other by communicating and trying to see what works and what doesn't work, and see if we can promulgate the stuff that works, not just in the medical side, but also on the economic policy side. So I would hope that that's at the least at the working level, that's what's going on, I hope. After all, the PPP, the US, as far as I know, never done anything quite like the PPP. They're trying to get it up and going. There are obvious problems. This is not a surprise, but I guess it's a long-winded way of saying, hopefully that cooperation at a working level will pay benefits at trying to figure our way out of this unique problem.
Right. Well, maybe what I thank you very much, John, and maybe I can turn to our Q&A with our global audience. And I noticed that, yeah, one of our first, Matthew Gelfand, has written asking a question that looks at less coordination now from 10 years ago, your point, and your four-tiered analysis from the privileged kind of insiders all the way to the steerage class. And I think he asked, you know, why is there less support for the neediest countries this time around? You know, and I think the way you've provided us with that tiered analysis to think about hierarchy as far as who has more privileged access within the system, and you know who's been left out, and to think about variation up and down the levels. I think that's a superb analytical framework for us to use. If you have any additional thoughts, you know, maybe even comparing last time, this time, using your four-tiered framework. Yes.
Well,
I hope you trademark, John.
Well, let me say the following. I have long advocated that one of the gaps in the international system is exactly that if you're in steerage, even if you're in premium steerage, well, premium steerage, it's a little different, but certainly if you're in steerage, you have no ready access to emergency liquidity. The fund has created some facilities that have rapid and in their name, and precautionary and liquidity line, et cetera. All of these provide quick access to medium-term finance, and since it's medium-term finance, then there are obvious limitations on how much you can lend to a borrower, because by definition, the folks may not understand this completely, the IMF's the resources of the IMF are a revolving fund. In other words, the very constitution of the IMF forbids, basically says that the fund can't lend its own funds out if it doesn't expect to get paid back, because that would be to squander the resources of the community, of the membership as a whole. But I've long thought that there should be a universal swap-like facility for borrowers that would reflect the move towards a world of more securitized finance rather than a bank finance dominated world that was the case when these facilities were first designed. So I won't go through the long sad story other than to say we almost got that done at the fund, and we just didn't make it. This short-term liquidity line now really is a swap-like facility, but it's so limited in its availability. But I'm hoping that over time it will become available more broadly, and that would take some short-term pressure off even the low-income countries. Next, an SDR allocation. You can talk about it in various ways, and it's a little bit complicated. I won't bore people here if you don't know about how the SDR system works. It's way complicated, other than to say, even if you give to another 250 billion, most of that, because it gets distributed to the fund membership according to your percentage, according to your quota. So the biggest guys get the most. And you can say, but the little guys get the least. And you say, yeah, but if you did 250 billion, the amount they got is non-trivial for them. It may look like a rounding error for the big guys, but for the little guys, it's real money. That wouldn't be terrible. But this problem is a little bit bigger. You just think that the fund, but especially perhaps the multilateral development banks, the World Bank, for the poorest borrowers, it seems to me, needs more funding, and that you can't just erase this degree of inequality so easily. And in fact, I've often wondered, once upon a time, there actually was an agreement that the funds provided by the IDA, the International Development Association of the World Bank, that's to their poorest borrowers. I've always wondered, why shouldn't that just be a grant? Why should that be a loan? Why should they have a repayment obligation? We're engaged in redistribution. Our main concern is that we're not just giving poor people fish, but teaching them how to fish. But at this time, they probably could use some fish too, and hopefully they'll get it.
Right. Well, it's very fascinating. This time, also, there's these two new institutions, these two multilateral development banks that China helped create, the AIB and the New Development Bank, so a little outside of the box. And they're also trying to step up now to do some things to help out in the COVID scenario. So, you know, that it'll be interesting to see how that also plays out with China being part of the story.
Yeah. But I would just caution, I mean, this is good, but you might take a look at the balance sheets. They're real small. We're not talking much money. And as I showed you, I bet you're surprised, the folks would be surprised that the outstanding loans to the poorest countries, the LICs, the low-income countries, in my graph over 10 years has hardly changed from the multilateral development banks. So it's one thing to announce big lending programs, that's good. But in the meantime, if you're getting paid back these loans, and so the net change in your net lending to these countries is not going up much, then you got to wonder what we're doing. Hopefully, on the one hand, we could provide more meaningful aid in the form of grants. On the other hand, it would be nice if we could figure out how to help these countries develop. That's a way more complicated question. That's what SICE is all about. But that's not a short discussion.
Right. Very good. Thank you, John. And another question from one of our colleagues at FPI SICE from Cinnamon Dornsif. Cinnamon asks, how does the Fed's role as contrasted with the ECB stack up now as opposed to during the global financial crisis? She also asked, what incentives, mechanisms exist to reach out to the economies left out? You've answered some of this, but also especially those that are current G20 members. And she asked, any further thoughts on pressures placed on China to become more transparent as far as playing by the rules? We've touched on some of that, but I just wonder if there's anything in there that you would like to take on, John, from Cinnamon's question.
ECB and Fed.
Right.
In the global financial crisis, as I said, there was a real crisis of the European banking system. There's the one everybody knows about, and that was if Greece was going to restructure its debts even though Greece was very small in the context of the European economy, the Eurozone economy, about 2.5% of the Eurozone economy at the time, the exposure of German and French banks to Greece sovereign debt was non-trivial for them. So that was the threat to the banking system that everybody knew about. I can't resist getting in a lick here, in that people say, and so the money that the European Union, i.e. Germany and France, gave to Greece was to help their own banking system. And my answer is, well, isn't that a surprise? Of course they did. They gave more than that. But the counterfactual is, if they hadn't given that, guess what? They would have given it to their banks at home. They were not going to let their banks collapse over loans to Greece. Okay. But the crisis of the European banking that nobody talks about, it was the near illiquidity / insolvency of a lot of European banks over their inability to borrow dollars when the interbank market froze, and the Fed saved their bacon. That simple. And the ECB, then, that was before the so-called European crisis, and it's then that the ECB took on a very aggressive and innovative role under the leadership of Mario Draghi to bolster confidence and to introduce innovative new processes. And I show from my graph, as you can see, the size of their balance sheet relative to the Eurozone economy was much bigger than the Fed's relative to the US economy. So in a way, what you see now, and again, we're getting a little bit in the weeds, but because the ECB was basically a merger of a whole bunch of central banks, and these central banks had disparate policies on what they would rediscount. The ECB sort of said, okay, whatever anybody in the system did, we'll do. So they ended up from the start with a much broader array of instruments that they were willing to rediscount. So that's how their balance sheet got big. So in a way, it's the Fed in terms of practice that became much more like the ECB. And now with the latest huge increases in the Fed balance sheet, their role relative to the US economy is going to become more like the ECB. So in that sense, we're all together, but the truth is the dollar is the world's reserve currency, and the Fed is the factory making the world's reserve currency, and they get it.
Right. John, there's one other question here from Ignacio Muno Alonso, a professor at IE Business School in Madrid, Spain. Yeah, he asks, in your opinion, what is the risk of this exogenous shock translating into structural damage in the credit system, as in 2008, and how would we avoid it if there is such a prospect?
Well, that's a very profound question, and of course, spot on one I didn't get into because we could give a course on that one, but it's pretty obvious. If the economies, we now see that the drop. I don't know if you saw the European Eurozone figures of the first quarter of the year dropped nearly 5%, and that's before the bad stuff hit. Second quarter is going to be worse. So this is just, we have no experience of something like this, and it's not because of economic problems per se. It's because of the lockdown that was imposed. Now, we're going to have a huge drop. With loss of income, et cetera, loss of confidence, nobody's going to know exactly what's going to happen. And you better believe that there is the potential that this could turn into serious credit problems if you end up with firms failing. And the part of the thing that I think has a lot of people worried and concerned is guess who's getting hurt the worst? Small businesses, individuals, et cetera. We all know this. How are we going to support them? What if they all go down? Isn't that going to end up infecting upwards into the business structure? What are we going to do about that? Could it lead to credit problems in firms and bigger firms? Of course it could. Could that lead to problems about confidence regarding the financial system? Of course it could. So far, the central banks have had great success in keeping folks calm. They've maintained the system flush with liquidity, and folks are hoping for the best, and money's around. But that's liquidity. And if the economic downturn is more prolonged than we hope, deeper than we fear, and more devastating in terms of the survival of firms, then we're going to have a different order of problem. And I can assure you folks are thinking about that and wondering what could we do to stop that other than, and if you're looking at the financial system, obviously the financial system can provide more lending, but the financial system cannot provide solvency to a bankrupt firm without creating a stability risk for the financial system itself. Real challenge.
Oh, thank you, John. I want to make sure, I think our time is running short. We're going to have to wrap up soon. I want to make sure to thank you for all of your excellent points. I also want to thank Johns Hopkins SICE, FPI, Carla and Danny for putting this together, this excellent panel. I just want to ask you one last question as a way to wrap up and give you the last word, which is, should we feel better this week than we did last week as far as how the crisis is evolving and our responses? And you've given us not only the doomsday scenario, but some resources of hope and optimism. So I just leave it to you as the last word, John. Thank you very much. Your
Well,
thoughts.
Greg, thank you. Thanks to FPI and my colleagues for doing this. I've certainly enjoyed it. I hope it's been useful to you. I'd be happy to hear from all of you and continue the dialogue. Are we better off this week than last week? I would say yes. Why? There are some better indications on the medical side. You may have seen that just today the ECB has announced new facilities. There's no question the central banks are going to keep the system going for the time being to try to keep enough oxygen in the economy that when we finally get over this pandemic or start to get to the other side and be able to open up, that there still will be a functioning economy that can regain health. So hopefully, fingers crossed, and let's hope that we can make real progress, because I'll finish the way I started. You can't discuss this without thinking about the human cost that this has entailed. It's striking and sobering, and it's something we're going to just have to deal with. But so that should fortify our resolve. Thanks, Greg. Thanks, Carla. Thanks to all of you.
On that note of optimism and also sober thought, thank you, John. Thank you to the global audience. Thank you to Johns Hopkins SAIS FPI.